In today's video, I'll share with you the 4 best Canadian ETFs that you can buy and put in your TFSA or in your RRSP if you're looking for great capital appreciation over time and a lot of passive income. Plus, at the end of the video, I'll share with you how I would personally build myself a solid portfolio if I could only put these 4 ETFs in it. Without losing too much time, let's get to it right now. The first ETF that I picked on my list is well known by many Canadian investors to track the world's largest market, which is the Vanguard S&P 500 Index ETF with the ticker VFV. This fund is quite similar to VUU, but with the difference that it is in Canadian dollars. So just like VUU, it is tracking the famous S&P 500 index, which is an index composed of the 500 largest American companies in terms of valuation. So within this fund, you can find great companies such as Apple, Amazon, Alphabet, and Microsoft among its biggest holdings. And with no surprise, the technology sector comes at the first place in terms of the sectoral distribution, followed by the healthcare, the financials, and the consumer discretionary. 10 years ago, if you would have invested $10,000 in that fund, you would currently sit on over $45,000. And this represents an average annual return of about 15%. Plus, on your side, by investing in that ETF, you can expect to pay some mere fees of about 0.09% per year or $9 per $10,000 invest. And so, for the same level of risk than the average of its category, this kind of ETF is able to reach a higher potential of return. Add to this fund is giving some great quarterly dividend distributions to their different shareholders. So, on your side, if you want to buy the American market in your portfolio, this is definitely the best option for you, especially since it is unhedged. It means that you will pay some lower management fees compared to the same ETFs that will be hedged, and so you'll be making your return depending on the performance of the underlying assets in this fund, but also on the performance of the currency exchange rate. But since I personally believe that both the Canadian and the American markets are both two strong currencies, I don't believe that it is necessary for you to hedge your fund. But on your side, if you're looking more for a Canadian ETFs that will give you more passive income and more dividend income compared to some potential growth, well, you could go for the Vanguard FTSE Canadian High Dividend Yield Index ETF with the ticker VDY. As its name is saying it, this ETF is tracking an index composed of high dividend yield Canadian companies that are found in the TSX market, and it is why you can find companies such as RBC, TD, and Bridge and Bell among the biggest holdings of this fund. And in terms of the sectoral distribution of this ETF, you can find that the financial sector is well represented with over half of the total ETF's value. And after, you can find the energy, the telecommunication, as well as the utilities sectors. This big tilt is mainly due to the fact that the Canadian market itself is way smaller compared to the American market, meaning that it is mainly focused into the financial and into the energy sectors. But the good news for the dividend investors is that those kind of sectors are usually giving some massive dividends to their shareholders, while usually being considered as some great defensive sectors. On your part, by investing in that ETF, you can expect to pay some annual management fees of about 0.22% or $22 per $10,000 invest. And over the last 10 years, your initial $10,000 investment would currently be worth about $25,000, which represents an average annual return of close to 10% per year. And despite being an ETF that has quite a little bit more risk compared to its peer of its category, you can see that it comes also with a lot more potential of return. So even if on a 10 years period, this ETF has been underperforming the first ETF that I've just presented to you, this ETF will tend to be less volatile and more stable, especially in times of high volatility on the market. And the big pros of you holding this kind of ETF in your TFSA is that all the dividend distribution that you will receive will all be tax-free, since all those companies that are found in this ETF are from Canada. But now, if you're looking to add some geographical diversification in your portfolio, I will share with you what is the best Canadian international ETF. And the answer to that could actually be the Vanguard FTSE Developed All Cap Except US Index ETF with the ticker VIU. This fund is tracking an index composed of companies that are found within developed markets except the North American market, so the US and Canada. It is why among the 3,800 different stocks within this fund, you can find great companies such as ASML, LVMH, and Samsung. Plus, the majority of the companies that are found within these ETFs come from the Pacific or Europe, as we can see with the 3 most represented countries within this fund, which are Japan, the United Kingdom, and France. And in terms of the sectoral sectoral distribution within this fund, you can find that the industrial comes at the first place, followed by the financials, the consumer discretionary, and the healthcare sectors. Since its inception on the market in 2015, if you would have invested $10,000 in that fund, it would currently be worth about $15,000 at the moment. And this represents an average annual return of about 5.50% per year. Plus, by investing in this fund, you can expect to pay some annual management fees of about 0.23% or $23 per $10,000 invest. Plus, while being in the average compared to its category in terms of the potential of return and the level of risk, this fund is also giving some great quarterly distribution to its shareholders. So if you're looking for great geographical diversification in your portfolio, this is one of the best ETFs that you can pick. And finally, for my last pick in terms of the best Canadian ETFs that you can buy right now, I've decided to include an ETF that could be quite interesting for you to hold in your TFSA or even in your RRSP, especially because of the distribution that they are giving. So I've picked the Vanguard FTSE Canadian Capped Rate Index ETF with the ticker VRE. This fund is basically tracking an index composed of Canadian securities that are found in the real estate sector. So you can find great Canadian rates within this fund, such as the Canadian Apartment Properties, Granite, and Ryocan. And in terms of the sectoral distribution of the kinds of real estate investment trusts that you can find in this ETF, you can find a great diversification between the retail REITs, the residential REITs, the office REITs, as well as the industrial REITs. As an investor that would be looking for a lot of dividend income distribution, this would be a particularly interesting ETF to invest in because all the companies that are within this ETF must distribute over 90% of their total taxable income in their different shareholders in the form of dividends. And so it is why those companies are able usually to provide some super high dividends that are however more taxed here in Canada. And on that point of view, since those are all Canadian companies that are found within this ETF, it is great to hold them in your TFSA because just like the second ETF, the big pros of it is that you won't have to pay any tax on the dividend income distribution that you will receive. And on their part, VRE is giving some great monthly distribution. Plus 10 years ago, if you would have invested $10,000 in that fund, this would currently be worth about $16,000, which actually represent an average annual return of about 5.50%. And on your part, by buying this ETF, you can expect to pay some annual management fees of about 0.39% per year or $39 per $10,000 invest. However, even if this Vanguard fund is able to give some higher potential of return compared to the average of its industry, it is also having unfortunately a lot more risk. And this is mainly due to the fact that the real estate is obviously depending a lot on the interest rate. But nevertheless, if you're looking to earn more passive income without having to buy different real estate properties, this could be a great alternative for you. So there you have it. Those are the 4 best Canadian ETFs that you can buy right now. Personally, if I had to create a portfolio with those 4 funds, I would allocate about 50% of my total assets in VFV. After, I'd put about 30% in VDY, and I would finish with 10% for both VIU and VRE. But on your part, if you're looking to find what are the best stocks that you can buy right now, check out the video that's gonna be right over here, and I will see you soon. Peace!